Ira, thanks for joining us here on In the Loop. I got to ask you, you think 10-year yields could go lower from here? How much lower?
Well, our year-end forecast is 175. I think that the risk is that we actually go a bit lower than that. And that's particularly true given some of the very weak data that we've received. And if confidence continues to be as poor as it is, and therefore growth expectations in the future continue to come down, then there's not a reason to think that rates can't go a bit lower than here. They might not stay there, but at the same time, it's hard to see how rates move a lot higher given the economic malaise that we're in.
And what is the bond market then telling us about the likelihood of a recession for the U.S.?
Well, they're saying it's pretty high, certainly not 100%. I think what it's telling you is that growth very long term is going to be, as you mentioned before, very subpar. It also means that inflation, particularly core inflation, which is driven significantly by things like wage growth and employment, is likely to remain muted and weak. We got some data yesterday that after 3 okay months of core inflation rising, we saw that core inflation started to move a bit lower again, and the fear is that goes back to zero where it was not so long ago, and that means that if that persists for several years of near zero wage growth and inflation growth and continued problem on the jobs front, then it's hard to see how rates can go higher. So the path of least resistance when you're worried about disinflation and deflation is for rates to go lower.
I was speaking to Alan Blinder yesterday, professor at Princeton now, former Federal Reserve member, and he was saying that he thinks that the likelihood of QE3 is quite high for this year. Would that change the landscape for interest rates?
Well, it depends on how it changes confidence. We don't expect QE3 in the traditional sense that they've done the asset purchases in the past couple of years. We do think that the Federal Reserve is going to be active. If nothing else, the Bernanke Fed is an activist Fed. They feel like they have to do something when growth is not hitting the targets or where they would like to be. So we do think that they'll do something over the next couple of meetings, like Operation Twist, which would be selling shorter-term treasuries in order to buy longer-term treasuries, and thereby putting a ceiling on how high mortgage rates could go, in particular, and also give a hint to the markets and to other economic participants that the Fed is looking for unique ways in order to stimulate growth, and certainly give an idea that they're not going to be hiking rates anytime soon, which perhaps was one of the problems with the other QEs.
Ira, at this point, it doesn't sound like you're worried about yields popping up anytime soon, but if we were to see a week with some strong economic data, could we see a massive trade-off or sell-off in treasuries?
Yeah, I'm not sure at this point that one or two numbers would do it. I think if you got a string of 2 or 3 months to do it, then certainly you can go back to the old trading range. For example, 10-year yields may be back above 250. But again, you need several months of that, and it would probably be more buying on dips in treasuries, where if yields get back up to 225, 235, that gets bought, because people won't necessarily believe the data until you get a string of them. We've had a couple of growth scares already over the last couple of years that really caught people off guard when that wasn't realized. Remember, we were talking about exit strategies in the first quarter, and it turns out that first quarter growth was really not good at all, and we thought it was much better.
What about
people don't want to get caught up in that.
What about some other potential risks to yields or yields popping? We've been talking about China, the potential that they will start to sell their position in Treasury. Certainly, they'll probably give some indication before that happens, but they've been vocal about saying the reliance on U.S. Treasuries is too high.
Well, I'm not sure that China will or could do that. We still have a very big current account deficit with them, so they have to recycle dollars if they want to keep their own currency tied very closely to the U.S. dollar. So the question is, what other assets could they buy? They could buy some physical assets, and they have done that in the past. but there's capacity and storage constraints there where you can't own you can't own more than you can store of a lot of physical assets. I think one of the risks is that you kind of get the better data you're talking about, and at the same time, the European situation is miraculously fixed. I don't know how that happens, but I think you'd need to get a lot of the uncertainty that we've had over the last 3 or 4 months kind of to alleviate itself all at once, and I'm not convinced that that's really realistic.
All right, Ira, we've got to leave it there. Thank you, though, for joining us here on In the Loop.